All right. Welcome, everybody. This is the Q4 2023 economic update. As you can see here on my screen, my name is Chris Rawson. This is my colleague, Brian Bly. We are going to walk you through. Let me share my screen. This is our agenda here. We are going to cover a number of topics. And what you'll see here, we're going to start off with the United States, and we're going to highlight the positive, the good, and the bad. We're going to be as basically direct as we can to show you both sides of where we are within the economy. From an international developed standpoint, the good and the bad. Emerging markets on both sides. Fixed income is another name for bonds, the more conservative investments. We're going to cover both components there. Within the investment model, what are we changing and why, and what's not changing? At the end, we'll have Q&A. As you can see in the chat, please type your questions here. We will answer all those questions. The formal presentation will, well, we'll see how long it goes. It won't take more than 60 minutes, depending on how we work through the material, and then we'll have Q&A after that. Okay, so let me jump in to the first slide, and we're starting with the United States, the positive components within the economy. The first positive component is that we have low unemployment. You've heard us say that a bit. We've had low unemployment for some time. This is a chart from Charles Schwab, and that's a really strong component. Additionally, in this chart up here, what you see is labor force participation rate. So for people aged 25 to 54, that's in the dark blue. The scale is actually on the left side here. So for people aged 25 to 54, over 83% of these people have a job. So that's really encouraging. And you see this uptick all year. Additionally, the folks who are age 55 and older, that's had an uptick. So it's nice to see that from a labor force participation rate, these are both moving in the positive direction. From a growth and of our economy, so that acronym is called GDP, which is another name for our economic growth. We are a consumer-driven economy. So this shows you components of growth. 68% of our economy is driven by the consumer, our consumer spending. Yes, we have government spending. There's investment minus housing. Here is housing. And then we do have some exports here. Or in other words, we are a net importer. We import more goods than we do export. So how is the consumer doing? The consumer is strong in the sense that when you look at this excess savings, so this is sort of COVID stimulus here. There was $2.3 trillion. Make this a little bit bigger. Yeah. $2.3 trillion. So a good bit of this excess cash has been spent down, but you see here, there's still over $1 trillion of cash that individuals have just sitting on the sidelines. So in terms of the positive components within our economy, we actually have a wrap up here in a little bit. But I'll just say this: consumer is strong, unemployment is low. There are a number of positive components within the U.S. economy. The other very important piece, and this has happened over the last 2 days, even in the last day, which you see earnings. So another way of saying that is profit margins. So profit margins, these are the S&P 500 companies, and this is the percentage on the left-hand side. On the bottom, we have the last 30 years. The profit margins are healthy. So when you see these technology companies that are reporting earnings yesterday, making significant sums of profit, that's a very, very important component. There are plenty of things to be concerned about. We're not going to ignore those. We're going to highlight those for you, but it's also important not to just, we live in a world where it's like, here's the bad, here's the bad, here's the bad. And we're going to sort of show you both. Profit margins, very strong, very important. And we got reminded of that even in the last 24 hours. Okay. The last piece on the positivity is that as the US, we are energy independent. Let me show you these components. This is US oil production. This is US oil consumption. If you look at our production, even let's look at last year, 20.3, and you also see this number is rising, 19, 20. So our oil production over the last 4 years has grown by 10%. When you look at our consumption has gone down by 1.9%. So even last year, 20.3, we're producing, we're consuming less than that. 2023, we are producing 21.6, we're consuming 20.1. We are energy independent. So we're going to cover some of the other concerns globally, but it's important for us to know that as a country, we are energy independent and we have tremendous natural resources. Okay. Brian, anything I may have left out on those first few slides there?
All good.
Okay. Let me turn this over to you.
All right. So we're going to stay with the United States, and now we're going to go on to the not so positive or the bad side of things. So this chart's a little busy, but kind of want to focus your attention more on the upper right, which is the headline CPI, which is what we feel as consumers in and day out. With it includes energy, housing, food, and everything else. So you see in May, the year-over-year headline CPI was 4.1. It decreased to 3.1 in June. But on kind of the bad side, while it's decreased over time, the last few months, July and August, we've seen an uptick up to 3.3, 3.7% in August. So while we saw inflation going down, as of recent times, we've seen it go up. And that chart down on further lower, where it's energy and food, core goods, those are month over month numbers. So as you can see there, for one example, month over month in August, energy increased significantly. So these are some of the components that are actually increasing the year over year amount, as shown there in the month over month figures. So consumer finances. So Chris spent some time on the good side of consumer finances, which is all good. However, there's some things that we're kind of keeping our eye on. So one of the things that we see in this, the lower right chart there, is the delinquencies, both from auto loans and credit cards. So as you can see there, over the course of the last year or two, and more recently, that uptrend is getting back to a normal, I guess, up to the normal level that we've had over the last 10 years or so. So while we didn't have a lot of delinquencies 21, 22, like during the COVID period, but we're now seeing some signs of loan delinquencies of 30 days or more. And you want to look at the orange yellowish line there. So that's student loans. So as everybody probably knows, student loan payments will be starting or have started. And so that number, that line there, while we're in this moratorium where loans didn't need to be paid, that line will probably start increasing as well, back up to the normal level. So just while the consumer is doing well, there's a bit of concern on the delinquency side with respect to debt servicing. With respect to GDP or net debt as a percentage of GDP, if you want to look on the chart to the right, We're right now about 100% of net debt as a percentage of GDP. If you look on the over the far left, a lot of our spending today is done in Social Security and Medicare, almost 47%. We do have some defense spending, while it's minor, as we know, there's some situations going on around the world where that defense spending actually may increase a bit. And then on the income side of things, and also the net interest payments on that is 10%. On the income side of things, we get tax returns, Social Security. I know the Social Security limits for where the taxes are withheld. That's been going up over the years. And also on the income tax side, even though we anticipate a lot of the current income tax structure is in place through 2025 based on legislature that got passed, we anticipate that the income tax rates will probably be going up just based on the fact that we are still spending a lot, probably going up around in 2026 to accommodate for all the spending that we have today. As you see there, we're also current borrowing about 1.4 trillion to help finance all of our spending.
Okay. We could probably cover even more, get into more details. If you have any questions there, again, add your questions to the Q&A or the chat. We'll cover all your questions at the end. Could definitely cover more here, but I think this is good for now.
Yep. So as far as another side, of course, we all know the interest rates have been rising and are continuing to rise. They're still at a high rate. So we anticipate there will probably be one more quarter point raise, especially given like what we saw earlier, where inflation is ticking up a little bit the last couple of months. So we expect another quarter point raised by the Fed, and projected that will be the last one, but who knows? We'll see what the data points to as we proceed through the rest of this year and into 2024.
Mm-hmm.
So just kind of summarize on the good side, unemployment remains low. Consumers doing relatively well. Companies are doing pretty well in the U.S. and we're energy independent. On the flip side, there is some concern on inflation year over year, just increasing slightly. We've got to keep track of the consumer loan debt default, government spending, interest rates. And then one thing that we had pointed on before is not to get into too much, but we do have the element of some government dysfunction. Of course, the Speaker of the House situation. We've got another debt ceiling kind of decision come up later this month. So we still have a little bit of dysfunction, which kind of sometimes provides a bit of a headwind to how things are going in the U.S.
Yeah, add some risk for sure. Just a couple notes regarding interest rates. The Federal Reserve is meeting next Tuesday and Wednesday, so you can anticipate some news on that. And then the continuing resolution is November 17th. So these are dates that are on our calendar that are we're expecting to be aware of, but that way it's not as much of an alarm. Okay, now we're going to shift to international developed markets and the positive components within that. So within the Eurozone economy, they have a similar economy to ours in the sense that unemployment is tremendously low, which is fantastic. When you see wage growth too, their wages are growing in part to account for inflation. Everything's getting more expensive. You'll see some of those numbers. But what's really, really encouraging is to see this low unemployment number. Then again, similar to the US, when you look at operating margins, which is profit for European companies, you see here, and even over the last close to 20 years, you could argue it's almost at an all-time high. similarly here, profit margins in the US, very, very high. So a lot of people working, growing their wages, and companies are profitable. These are important components that we want to make sure that we're highlighting as we're looking at the entire picture. So global inflation is coming down. This is a Schwab chart. This is the developed market, and then in the lighter blue is emerging markets. So you see the trend in place where inflation is declining, and that's the reason why, of course, both domestically and internationally, we've had higher interest rates. The additional component that we're highlighting, and the reason why we own international investments in our portfolios, is the valuation. So when we compare the valuation of international positions compared to the US, they are what I'm trying to say within this is that they are inexpensive. They are value. There's a value in buying these positions when you look at the earnings that they're generating. And then additionally, when you look at the dividends, we're going to cover this a little bit later in the presentation. The dividends that the companies pay in Europe is meaningfully higher than the dividends that then are paid in the US. So both from a valuation standpoint, there's a value here, and the dividends are healthy. So this is an important component of the why behind why we own international funds. Okay, Brian, let me turn this part over to you.
So likewise, we'll hit a bad element to the international development market. So similar to the US, interest rates in the international developed markets, Eurozone, UK, Japan, all well, except for Japan, the exception, all remain high. So the Bank of England is projected to, like the US, increase their interest rates a bit more. The European zone, ECB, will probably remain a little stable and start declining it over time, over 24 into the years ahead. And then at the bottom there, you'll see the Bank of Japan, which has really been not as in sync with the rest of the world. Their economy's been doing well, but they're even projecting to start hiking rates starting into 2024. So with the exception of Japan, really the downturn, just like the US, we've all been fighting inflation. So the rates have been high, and they'll be high until inflation gets tamed in the respective areas. Just to kind of recap here, as Chris mentioned, all the good European Eurozone are doing well from employment, wage growth, companies are doing well. Inflation is declining. While it's high in some places, it's been declining overall throughout all the developed markets. And then the equity valuation, once again, is attractive to the US.
Okay, so emerging markets, let's highlight the positive. The biggest component is India. And so what this chart from JP Morgan is showing us is the working age population and the trend. So the trend in terms of working people in India is a real bright spot. And here you see China. So this is likely from the one-child policy that they have that ended up being not the best approach, which they've since gotten rid of. But this trend is already in place in India here. Additionally, India is incentivizing companies to move there. And so you see government spending. Government spending is increasing, and then they're also incentivizing from a corporate tax perspective. So the corporate tax is here at 25%, similar to China, but there's the incentive too. So if you move your company to India, you're seeing a lower rate than the existing companies. So they're this is the main highlight in terms of the positivity. And we all know the bad. The bad is what we see on a day-to-day basis. So Hamas's attack on Israel, we have the Russia-Ukraine war ongoing, heading into the winter. So as the ground freezes, there's not a lot of movement that's going to happen there. And this BRICS currency was talked about, I don't know, maybe a month or so ago, which is this currency from Russia, Iran, and China to essentially interact with each other and try to move away from the US dollar. This is not a concern. More than ever, even these bad actors are revealing themselves as just that. So this BRICS currency is a way for the bad actors to try to figure out how to work amongst each other. And as that relates to the US dollar and not being the denominated currency of the world is not a concern. But we didn't want to ignore the fact that there was some talk about that, at least this quarter anyway. Okay.
All right. So yeah, so we'll transition now over from kind of the equity side of things to more the fixed income and starting off the goods. So so really want to bring your focus on the left chart and the diamonds at the top. So as I mentioned, you know, while inflation has upticked the last couple of months year over year, you can kind of see, you can see here where the year over year figures by the diamonds, where it peaked at the 91.1%. It's come down steadily over the course of the last year, 12 to 18 months down to the current rate. So it peaked at 9.1 and now we're at, you know, in the 3 level. So from a positivities perspective, looking at a longer term perspective, inflation has been tamed by the higher interest rate policies taken by the Fed. And this is really want to focus you on more of the short end of the yield curve here. This is basically showing we're making good money on cash. So your high yield savings accounts, as a lot of y'all have seen, the monthly interest that you're accruing and getting credited to your accounts is great. So, you know, we still are at a high level of yield. And we're seeing the fruits of that, especially in the high yield savings accounts.
Mm-hmm. Okay. The negative components of rising and high interest rates. There are a couple of focal points here. One is in the smaller banks. The smaller banks have a greater exposure to commercial real estate. So what you see here is asset exposure by bank size. So smaller banks are exposed to commercial real estate. The top 25 banks to a lesser extent. Additionally, when you look at the trend of US vacancies, this is office here. So office vacancies are rising. This is the sort of evolution of return to the office. Some people are remaining remote or a blended strategy. In larger cities like Chicago and New York, they're going to turn some of these office space into residential. So it's not that these buildings are going to remain vacant forever. There will be some evolution to this. However, in the short term, the exposure to the office space and the increase in vacancy is certainly a concern. So, and when we look at the overall, so the more conservative components, the positive of having higher interest rates is that it has reduced inflation over the last year. And you're all enjoying the interest on your high yield savings account. If you don't have a high yield savings account, feel free to send us a note. We can point you in the right direction, how to maximize the interest on your cash. There are negativities to rising interest rates. Smaller companies have a hard time growing because they have less access to capital, and the interest rates have slowed the real estate market. Within that, of course, the smaller banks are the concern within this bond area and their exposure to the commercial real estate side. Okay, what are we doing on your behalf and why? The first piece is that we are migrating from some of the CDs that we've had over the last 2 years into more what is considered traditional bond funds. The reason why is, and I have a number of charts to walk you through this. Interest rates are approaching their peak. So what you see in this chart is this gray diamond, peak CD rates, which is what we've been having. These peak CD rates are here. Where we're migrating to is the Bloomberg US aggregate bond. We're not owning that index specifically, but it's representative in this chart. So when you look at this dark blue bar, it's higher than the CDs. Additionally, when you think about, if you imagine a seesaw in your mind and you have interest rates on one side and bond values on the other, when interest rates decline, bond values increase. So over the next 2 years, interest rates are going to be going down. Looking forward, the reason we've had the CD is because when we look at the last 2 years that we've had, interest rates have been rising. So we moved out of this more traditional bond position all the way up basically to this fulcrum point here, because other people have been losing money in bonds over the last 2 years. Well, again, now that we're arriving at the peak of the interest rate hike, we're moving longer term and into those more traditional bond positions. This is a chart from Fidelity. So this shows the historical performance when you're moving from the short end to more intermediate bonds after the Fed is done hiking. And what does it look like 12 months later? So these initiatives are in the 12 to 24 month perspective as we're making these adjustments on your behalf. When you see, this is the Bloomberg Aggregate Bond Index, this is the 6-month Treasury. These green components show outperformance in more traditional bond positions rather than holding short-term CDs or even 6 months Treasuries. So this is one of the things that we're changing. Additionally, as we think over the next year to 2 years and interest rates declining, this JP Morgan chart is showing the 1% rise in gray and the 1% fall in blue. So over the last 2 years, interest rates have been rising. So you see negative results here. There's a certain subset and very specific places to hold bonds as interest rates have risen over the last 2 years. Looking forward on the 2-year mark, this is more of what we're going to see, the blue component to this chart. So again, interest rates are going to be going down over the next 2 years, and we're making these decisions to put you in a position to benefit from that longer term. Brian, let me turn this piece over
So
to you.
this is looking at equities, and this is something that we've got. It's not a right now, but we're looking at more of a 1 to 2 year time frame. If you look at the lower right chart there, this shows the equity valuations, their current price to earnings ratio as compared to the 20-year average. As you can see there, the large cap price earnings is above 100%. And then when you get into especially the small, you'll see that below, well below, anywhere from 7 to 15, 16% below the historic average. So one of the things that we'll be looking at, if and when we get into recession, we'll be looking to reallocate some of the large cap over to small and mid caps to kind of take advantage of this situation, this mispricing. So this is, once again, this is more of a, not necessarily right now, but more of where the puck will be going if and when we hit in the recession 1 to 2 years out. We'll be looking to move into the small and mid cap area more aggressively over time. So as Chris mentioned, we're moving from CDs into traditional fixed income or traditional bonds, short and intermediate term. And we'll continue to look at increasing the duration, the length of the particular fixed income instrument as we see the interest rates stop rising and potentially decreasing sometime in 24 and beyond. And then, like I just mentioned, we also will look at increasing the allocation to small and mid cap if and when we see a recession. We're not there yet, but when that time occurs, 1 to 2 years down the road, whenever it may be, we're looking further out in the future of what other transitions or other changes we may be making. As far as what is not changing, as an example, we're just showing you the IRA moderate model. We've got several different models, but this is the IRA moderate model. So one of the things we are not changing is the allocations to equities, both US and international. We're keeping those in proportion to one another as we have now. So we're not planning to make any changes to those relative to one another. And likewise, we are maintaining our large cap tilt. As you can see here, we've got, for this moderate model, 36% of our 44% allocated to equity is in large cap, with smaller portions in mid and small cap. So as of more near term, we're keeping those allocations the same, being a little bit more defensive on that front. As well, on the defensive side, this is, once again, this is kind of the risk-alize. The risk number is fairly low on this portfolio. One of the things that we are emphasizing is dividend paying equities, both in the domestic US front as well as international. So you'll see here a couple of funds, dividend tilts, dividend growth, just yield generated both from a US perspective as well as an international. So as indicated before, what's not changing, our allocations between US and international equities, are overweight to large cap, and then our dividend focus, particularly in the large cap area for both US and international markets.
Okay. We changed the format slightly. Let me stop sharing my screen for a moment. If you would, we have one question. We're going to get into the Q&A now. And there it is. We will stop sharing. This is the formal portion of our prepared remarks. Essentially, we changed the format slightly to highlight the positive and the negative, not wanting to just look at the world through rose-colored sunglasses. So here again, feel free to type your questions into the chat or the Q&A. We'll cover these. We always want to get your feedback. So there's 5 really brief questions. We really appreciate the feedback. Additionally, you'll get an email tomorrow with the playback. So all the feedback is very welcome. The first question, how can there be low unemployment when all retailers and businesses are unable to fill all of their available positions? So if I understand the question correctly, in part, it's because there are so many jobs. We have more jobs available in this country than we have people looking for work. So that might have been on the second slide, right, Brian?
Yeah.
So if I go to page 3. Okay, job openings. Let me see if I can make this bigger and move this over. Here we have unemployment. Unemployment is low. Granted, like we had talked about, the labor force participation is high and growing. The number of jobs that are available, job openings, there are more job openings in this country now than we have even people looking for work. So you're exactly right. This is part of the reason is the good news with the economy is there are more jobs available than people looking for work. It's close to like 40%. There are 40% more jobs available than people looking for work. Most of the time, that's not the case. So you would see people, we go back 10 years, people who are unemployed are here, available jobs is less. That's more normal, where people are trying to compete amongst each other for fewer jobs. Right now, that's exactly the opposite. There are more jobs available than people looking for work. So hopefully that you feel is an adequate answer. And we answered that. As US earnings appear high, why does it seem this is not reflected in the market? Well, let me stop sharing for a moment here. I think in some regards it is and it isn't. I mean, you look at the market yesterday, there was a big positive upturn in the market because of earnings. I guess if I were to say it differently, is because we live in like a negative news world right now, where that's the messaging that we get. And that's also the reason we host this event, is to not ignore the negative, but give some of the positive components a little bit of time to say, this is what's good about what's going on, because we're getting peppered with the bad all the time. Okay, I think hopefully that's an adequate answer, and the fact is that it is. And so even today, there's more technology companies reporting earnings. We're going to see more results coming this week of profit within these companies. What's your definition of emerging markets? Is that other country blended with the US? Brian, you want to take this one in terms of the definition of emerging markets?
Well, emerging markets are, as far as emerging markets are concerned, there are the markets like China is still considered an emerging market. A lot of Southeast Asia, the Koreas, India is included in emerging markets. And then you've got some countries like Russia, Brazil. Those are not quite to the level of the developed markets that we have like in the Europe countries. So they're the smaller markets that may eventually transition to a developed market.
It says, is that other country economy blended with the US? And I would say no. The way that we are presenting this material, and even as Brian and I filter through the research, the US is a very specific component to the portfolio and even the analysis. The international developed, which is more like Europe, for example, just to give you one example, and then emerging markets are the ones that Brian just highlighted. And to a lesser extent, we have some exposure to emerging markets, but a very low extent.
And the emerging markets, those are companies actually based in those, headquartered in those countries. So of course, we're not a totally isolated world. So, we've got companies that are US based that do have operations worldwide, sell worldwide. So there's portions of even the US where they're dependent upon international developed countries or emerging markets, but emerging market companies themselves are the ones, or the companies are ones that are based in those emerging markets that I named. Some examples.
Okay. How does Japan maintain low interest rates? What can the US learn from this? So Japan is having their day in the sun right now. Paul, thank you for the question. So the other piece that we covered earlier is the US debt to our growth, to our production, and it's approaching 100%. Japan had debt to GDP of 200% at some point in their history. They had a greater concern of actually deflation. Deflation from an, if you ask an academic about economics, is actually more concerning than inflation, because that stifles growth, because people have inactivity. They don't do things because they're anticipating things becoming less expensive. Inflation is easier to fight, which we're dealing with the frustration of it from a what's called open operation, markets operation. They just raise interest rates. You raise interest rates, inflation goes down. That's sort of the mechanics of it. What can the US learn from this? Japan struggled in this process. So there were some things that hadn't gone well for Japan for a long time. They're starting to see some inflation, and they're going to be raising their interest rates. There are things that need to improve in our country. What we also didn't list there is we have a very deeply divided country, and government dysfunction, which makes it really tough to make policy decisions. And that's why we don't have the Speaker of the House, and this continuing resolution needs to happen by November 17th. So I think, unfortunately, we're going to see some more dysfunction between now and then, and an 11th hour. I don't even know how to describe it. An 11th hour something is going to happen at the 11th hour. So that's what we have to expect over the next 3 weeks. Okay, next question. How is the US economy impacted given China and India are catching up or passing technology and manufacturing capacity perspective speaking? Let me repeat the question. How is the US economy impacted given China and India are catching up or passing us from a technology and a manufacturing capacity? Brian, let me let you take that, and then I'll comment.
Yeah, so I mean, from a technology perspective, I'm not sure. I don't really think they're surpassing us per se. From a manufacturing perspective, yes. I mean, the United States over time has transitioned from a manufacturing to more of a service-based economy. So, as we transition to that, likewise, China and now India is potentially taking over, or might be taking some of the manufacturing capacity away from China. They have transitioned from a manufacturing perspective. From a technology perspective, of course, we've got a lot of this, especially with China, this restrictions and all that's going on. I'm not really sure that they have caught up or passed. I mean, they've just evolved naturally and have gotten better at certain things, but I don't think, at least I'm not concerned with them with respect to passing the US from a technology perspective.
I agree. I don't think that they're surpassing us. There are concerns in cybersecurity. Part of the pandemic is the chips. We're starting to add manufacturing to build the chips in the US. Even companies from South Korea, where a lot of these Taiwan semiconductor companies are moving their manufacturing to the US to manufacture the chips here in the US. So from a cybersecurity perspective, I still think that the leading edge of technology is in the US, and it's more of how do we protect ourselves against cyber attacks against China and Russia, who are notoriously focused on cyber, attacking through cyber. I think we adequately answered that question, but for that person, feel free to expand if there's more that you'd like to hear. Fed rates have a lagging in effect, which is expected to be seen in Q1, Q2 of next year. When small business restructure debt, do you expect this to put the economy into a recession and reduce job openings? I'll take an approach on this, and Brian, be interested in your input. So Fed rates have a lagging effect. Small business restructuring their debt. Their restructuring comes in waves. It depends, like we showed, the difference between the bigger banks and the smaller banks. A recession is there are a number of definitions of a recession. I don't necessarily see a recession in the next 6 months, because as you've highlighted, there are more jobs available than people who are even looking. But the trend is going down. So we do recognize that the amount of excess jobs is coming down. More and more people are working. And you even, going back to that earlier chart, is that age 25 to 55 are working at 83%. And people who are over age 55, it's increasing. So some of these jobs are being filled. So do we, I don't know that I want to misinterpret the question. I don't see a recession in the next 6 months, which is why we're sort of presenting our strategies on a 2-year basis. Although when things happen quickly. So this international turmoil is concerning. We're highlighting the positive and not ignoring the negative. Typically things can happen quickly. So I don't anticipate rising interest rates to cause a recession currently. And if we start to see some of major layoffs and a change in the dynamic in terms of available jobs and unemployment, the Federal Reserve is going to start lowering interest rates very quickly. The expectation is that the Federal Reserve is going to lower interest rates 2 times next year by 0.25 and 0.25, which is a little bit too balanced. The idea that it will just be this sort of like, glide path is just not likely. They'll likely make quick changes more quickly. Brian, let me get your input. What are your thoughts on this question?
So as far as small businesses, I mean, I know, right, I guess as far as the ones that made it through COVID, I mean, that's great. As far as the ones that have come out of COVID and are still existing or have reformed or formed anew, there could be some pressure on them. And small business are a primary job openings, I'm trying to
employer.
my words. As far as a primary employer, there are a lot of small employers that are small business are some primary employers in the US, but I don't think, especially given the ones that have survived through COVID, I mean, while there might be some small businesses that feel a little bit pressure when they have to restructure, and will no longer have openings or may have layoffs. There's nothing, at least at the current time, that's too concerning.
And additionally, it's like if any company that needs to restructure their debt or even refinance, it's not a surprise. I mean, these CFOs are aware of what's going on. They're probably talking to their bank now. And so whatever they're anticipating, part of it goes back to the consumer. 2/3 of our growth in our economy is driven by the consumer. The consumer is strong in the sense that there's low unemployment. And the other reason we have the definition of inflation is the same amount of goods and services, or even the same amount or fewer, being chased by more and more dollars. So inflation's been further exacerbated from COVID because people are just spending money. It's like inflation be damned. It doesn't matter what the price of the plane ticket is or whatever. People are spending money just so that they can enjoy life, because we went through a real challenge during COVID. Now, that's an anecdotal comment behind the sort of the trend of inflation. But the policy's working. So the Federal Reserve, they know what they're doing. They know, and that's why we're highlighting here that there is an uptick in inflation. That's why we may see interest rates rise next week by another 0.25%. So I think hopefully we answered that question. Okay. Next question. When the US consumer sneezes, the rest of the world catches a cold. So yeah, that's Mark, thank you for that comment. And so we're, that is a part of the component, which is we live in a consumer driven world. What's the highlight is you see the profitability. The profitability of US corporations is extremely high. Profitability in the Eurozone is extremely high. So it's encouraging to see that these companies have high profit margins. And so that gives them something to work with. Alice has updated us. No defected votes against Mike Johnson, Republican from Louisiana and the Speaker of the House as of. So it's a very, very fluid situation. Yes, we'll be looking for a Speaker of the House, and we'll look for the hope of not an 11th hour chaotic continuing resolution leading into mid-November. So we can all enjoy our Thanksgiving and, enjoy the positive components while here again, not ignoring the negative. Okay. If you have any additional questions, feel free to email myself, Brian. It is an honor to work for each of you. Please give us your feedback. We comb over the feedback. There's, I think, 5 just cut and dry questions. Give us, what's good, what's bad, how can we improve? And we look forward to continuing to work for you through the rest of this year and into next year and beyond. So thank you so much. Talk to you later. Bye-bye.